Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time home buyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
Hey everyone, I think it's not too late to say Happy New Year. 2026, here we are enjoying another year, and I'm out here in the East and I can tell you it is absolutely freezing. We have snow, records amount of snow, but I'll tell you what keeps us warm is all this turmoil in the economy, our friends from the South. But I am always comforted when I'm joined by Dr. Sherry Cooper. Sherry, welcome. Another year together and in conversation with. Isn't this exciting?
It is very exciting. 10 years.
10? Is it 10 years? A decade?
It is.
Well, and look at you. Like, obviously, you're in Florida. You're very Florida looking. While we
well,
freeze.
it's cold, but
is it cold? Yeah.
like what you have.
No, I think it was minus 10 or 11 today without the wind chill. But anyways, regardless, we heard the announcement today. No surprise, no change, but there is a lot going on, isn't there?
Yes, there is.
There is. So just a reminder for everybody watching. One is we're going to get through the entire presentation. Sherry has over 70 slides, but she promised she'll go through them quick. Please send your questions. You can send them as you think of them. As Sherry's going through a presentation, I'll get to as many as I can. I know we have a lot of great questions. Sit back, relax, and Sherry, let's go through this, and we'll get back to everybody once you're done. Here we go.
Thank you. Okay, well, here we are, Canada in the crosshairs. And boy, are we ever since Prime Minister Carney's speech to Davos, wow, that has rocked the world. And though he's gotten kudos and a standing ovation, the American administration sure doesn't like it. You notice in my opening graphic, I've got the shadow of Donald Trump overlooking a chaotic world, and that is certainly apt. So much is happening, and there's the great uncertainty of what's going to happen with the Canadian, Mexican, U.S. free trade agreement. We call it CUSMA. Great deal of uncertainty there. It's technically we're not supposed to begin the renegotiation until July. I'm not sure it's going to happen in July. I have no idea when it will happen. Neither does Donald Trump, for that matter. But I think the U.S. would be very foolish to just walk away and end the deal in the 6-month time frame. But stranger things have happened. Today, as Eddy mentioned, both the Bank of Canada and the Federal Reserve were on hold. So let's look at that and what does it mean indeed? What are we expecting for the future here? Canada is the #1 market for U.S. exports. And in fact, to be fair, This looks at U.S. exports by country, and you can see that it's really Canada and Mexico that are tied for first. At 17% of U.S. exports go to Canada and Mexico. Only just over 7% goes to China. So this is why is Trump so concerned about trade deficits and so in love with tariffs? Well, this is the number one reason. Now, 36 American states say that Canada is their number one export market. So, and many of these states are importing oil or electricity from Canada. These states have been quite vocal in telling Trump and his administration that they're not happy with what's going on now, that they find themselves in a very difficult position. Now, this chart shows the top U.S. import partners. Mexico takes 16% of the imports to the U.S. China's 14%, Canada's only 13%. And then there's a big gap with Germany at 5%. Again, the U.S. would like to see them having this huge trade surplus, even though that doesn't really make economic sense. Now, Canada is much more dependent on trade than the U.S. If you look at just one particular measure, exports of goods and services as a percent of GDP, you see that it's more than triple in Canada, the level in the United States. It's 34% of our economy. But I'm quite optimistic about Canada because we have a competitive advantage in so many of the products that the rest of the world wants and will demand in the coming decade. That would include critical minerals that we know are in the Ring of Fire, part of Ontario. We have tremendous energy resources, of course, oil, hydroelectric power, liquefied natural gas and natural gas. Our agri-market, agri-foods, agri-fertilizer, potash, you name it. We're very productive and very high quality. And we have Arctic access and fresh water. These are just examples of things that Canada is rich in that the rest of the world wants. Now, even with the latest negotiations with China, where Carney agreed to allow low tariffs of only just over 6% on electric vehicles made in China, he's agreed to allow 49,000 of them into the country. They cost roughly 35,000 Canadian per car with the 6% tariff. So that amounts to just shy of $2 billion worth of trade. Really, it's a drop in the bucket compared to what we trade with the United States. You can see in the chart that the orange line here is the exported value to Canada and the imports by Canada. And when you look at the Canadian trade with the U.S., it is far, far bigger than Canadian trade with China. So clearly, Canada's goal is to diversify trade away from the United States. Now, we are in the crosshairs. Trump has been trolling Canada for years now, and most recently called Prime Minister Carney, Governor Carney, an allusion to Canada becoming the 51st state. Now, Trump said the other day that there would be 100% tariffs if Canada trades with China. That, by the way, is not what he's really saying. What he's saying is We don't like if you get too cozy with China, but too bad. China is the #2 market in the world, and Canada definitely will be doing trade with China. Now, with all this uncertainty, it's not surprising that gold prices and silver prices are hitting record highs. It's all because of VUCA. VUCA is a term that was created by the U.S. Defense Forces. It's an acronym. The V stands for volatility, uncertainty, complexity, and ambiguity. And we have all of that in spades. And as a result, confidence levels, both consumer and business confidence, has fallen in Canada. U.S. consumer confidence is at a record low. In fact, the last time we saw anything close to the plunge was back in 1984, quite a long time ago. Uncertainty around the Canadian economic outlook is extraordinarily high. And as a result, I think it's very important to keep your options open and know that it is quite possible that we're going to see more volatility in our markets than what we would consider normal. Now, a year or two ago, virtually all Bay Street economists were calling for recession in Canada in 2025. We didn't get a recession in Canada, and I think that speaks to the resilience of the Canadian economy. This shows you the quarterly growth rates. We had a big decline in the second quarter, minus 1.8%, bouncing back in the third quarter of this year to 2.6. We haven't received the final data on the fourth quarter GDP numbers, but we're forecasting it to be about 0.5%. And then for next year, we see the 2006 growth picking up a little from 2005, but even stronger still in 2027. So this shows you that per capita GDP growth in Canada is now positive. Now, we have been talking for quite some time about negative per capita growth in Canada. That was when our target for permanent foreign residents was at 500,000 people per year. They've reduced that number considerably to shy of 400,000, and they've dramatically reduced the number of foreign students and temporary foreign workers. So as a result, per capita growth now is rising. Manufacturing has been very weak, and you see this in the all industries number for manufacturing sales. Most notably, manufacturing of goods is very weak, and educational services as well. Now, this shows you that Canada's auto factory sales hit a 3-year low. The auto sector is one of the hardest hit sectors in terms of uncertainty. Yes, CUSMA protects us from tariffs on most automobiles and auto parts that are exported from Canada into the US, but in the future, Trump is certainly threatening to renegotiate NAFTA so that autos would not be a part of it, and we'll see what happens. But certainly to date, we've got manufacturing sales, motor vehicle manufacturing, wholesale sales, and parts and accessories all declining sharply in the latest data, which is for November. And this shows you the rise in employment insurance claims by users in different metro areas. And you can see at the top of the list, Oshawa and Windsor, the two central hubs for automobile production in Canada. We also see those figures rising in Vancouver, Montreal, Quebec City, virtually everywhere in Canada. Another very important component to the outlook is on the fiscal side. Now, we focus a lot on monetary policy because we are in the housing market. And there's no sector of the Canadian or any economy that's as sensitive to interest rates as housing. But fiscal policy also affects interest rates, and we're seeing that already. Look at the debt ratio of the US government compared to the Canadian government. The central government total gross debt ratio, that is total gross debt as a percent of GDP in the US, is approaching 125%. Far, far lower in Canada, shy of 60%. And then with the big, beautiful bill passing in the House, that will take the debt to GDP ratio up to the 125% that was posted a few years ago in the wake of the pandemic. Now, the US dollar has fallen significantly since Trump took office. It's bouncing around the 97 level. This is an index of the world's currencies vis-a-vis the US dollar. The Canadian dollar more recently has appreciated with respect to the US dollar. We also see that China is selling US Treasury bonds. Their holdings of US Treasuries, shown in the black line, are declining. Over the same period, Japan has increased its purchases and is the #1 foreign purchaser of US Treasury bonds. And you can see here that the UK has also stepped up its purchases of US dollar bonds. Now, the UK owns more US Treasuries than China. A major, major shift there. Also, US customs duties are surging. This will help to reduce the US federal budget deficit. Now, I want to point out that even before the Carney flew to China and agreed with Xi Jinping to step up their purchases of EVs in exchange for China buying more canola oil seeds and canola meal. Even before that negotiation, you can see that China, the pink line here, China's purchases of oil from Canada is at a record high. And again, on this side of it, you see that Canadian oil export volumes to China has risen by 84%. Incredible. Now, this shows you that Canada has the smallest deficit to GDP ratio in the G7. So this is, again, another very important factor. It gives us some breathing room here, some borrowing room. We know that Canada will be investing more in defense, so there will be stepped up government spending there. And Carney has asked all federal government departments to look at their budgets and to cut wherever possible. You can see again, this is Canada's deficit to GDP ratio. These are the countries that, including Canada, have a AAA rating by the major rating agencies. And Canada's deficit is very small compared to these countries. Smaller still, though, would be Switzerland, Denmark, and Sweden. And you can see the other G7 countries that are not AAA, UK, France, and the US. The US is the big danger here because the US is increasing its spending, increasing the fiscal policy and absorbing the cost of that. In part, the trade duties will pay for some of it, but only a very small part. Now let's talk about Japan for a minute. Japan is in the news. Japan's bond crash unleashed a $7 trillion risk for global markets. This is a headline that we saw on Bloomberg just this morning. So what has happened is, unlike in earlier years when Japanese interest rates were the lowest in the industrial world, and in some cases they were negative, bond yields in Japan have risen dramatically. The 30-year bond yield now is around 4%. The reason is record high debt ratios in Japan. Japan has an even larger debt to GDP ratio than the United States at 236%. Now that's down from 250% a couple of years ago, but nevertheless, that was in the wake of COVID. But nevertheless, these are pushing up against boundaries at which foreign investors are no longer interested in investing in these securities. The U.S. has been supporting the yen in this process. So clearly the Fed understands how destabilizing these kinds of movements can be, especially at a time like now when there isn't a country in the world that hasn't been impacted by conflicting US trade demands. Now, this shows you the Canadian federal debt to GDP. It's no longer on a declining path, but in fact, it's beginning to edge upward, but still below 45% deficit to GDP as of the March 2025 budget. Now, what do I have to say about this? Given that it's less than half the level in many European countries and certainly in the US and Japan, I think that this is a cushion for Canada and one that we could well use. Now, just looking historically, it was much worse than it is right now. We used to have a debt to GDP ratio in the early 90s that was almost 70%, still half the 150% in Japan, but still very high by historical standards for Canada. Our budget deficit is nowhere as big as it was during the worst of COVID. And you can see the public debt charges as a percent of revenue in Canada are modest. Now, this is again, the Canadian budget is intending to promote business investment. Canada trails the US in business investment. The shortfall versus the US has grown considerably since 2015. So business investment is generally investment in technology, and that improves our productivity, which is very important. In addition, AI will improve productivity, and we've seen the beginnings of that process happening very considerably around the world. Now, looking at the labor markets, the Canadian unemployment rate has risen to 6.8%. The job market has softened. You can see that the job gains have diminished dramatically in December. And then the unemployment rate increased from 6.4% to 6.8%. Clearly not good. And judging from survey data, more people expect to lose their jobs. This is the number of people who say the probability of losing a job over the next 12 months has increased. Canadian inflation, we just saw the inflation numbers this week for December, 2.4%. Very good report, actually. We saw an increase in the headline inflation from 2.2 to 2.4%, but it's largely the result of base effects 1 year ago when there was the rebate on GST, and also rising grocery prices. Rising grocery prices are a very visible inflation expectations indicator. And clearly people are howling over the cost of groceries. This shows you that grocery price inflation now surpasses shelter inflation. So you can see that shelter inflation has come down from very high levels. This includes rents, renovations, and mortgage interest. So down considerably. Now, food price impact is big, and Carney announced this week an increase in the GST rebate of 25%. And 25% per year over the next 4 years for those who qualify. So this is a big component here, and it will help in the affordability issue. Another good thing about the inflation report is you see that the bank's favorite measures of core inflation have trended down very dramatically in both the CPI trimmed mean as well as the median CPI. In both cases, we've seen a marked deceleration to around 2.5%, which is just fine with the governing board of the Bank of Canada. Inflation breadth has widened. That's the share of CPI components that are growing over 3% at an annual rate. And that's ticked up, although it's way down from what it was in 2023. So we've seen inflation under control today. In the press release by the Bank of Canada, they commented on that. Oil prices had fallen to below $60 a barrel. It takes at least $65 a barrel for oil businesses, to want to invest in extracting additional oil. Now, as a result of the violence in Iran and the disruptions in Venezuela, oil prices have increased since early January. So you see that they've ticked up a bit, but at 62.77, it's still historically low. So today, no surprise at all. Bank of Canada held the overnight rate steady at 2.25%. 2.25% is considered the low range of neutral interest rates. In other words, neutrality means that monetary policy is neither contractionary nor expansionary. It's in a neutral position. This shows you the overnight rate in both Canada and the US. Our overnight rate, policy rate, 2.25%. The US, they use a range, is at 350 to 375%. Now, 2.25% may well be the low in Canadian policy rates for this cycle. Now, the only way that the Bank of Canada will cut further this year would be if the economy were to go into recession. That's not my base case forecast, so I'm not predicting that. However, for the US Federal Reserve, the Fed is expected to cut interest rates 2 or 3 times this year in the second half of the year. So we'll see whether that happens. Now, the 5-year yield is the yield that helps to determine the fixed mortgage rate, the 5-year fixed mortgage rate. The 5-year yield, as edged down ever so slightly recently as the Canadian job numbers softened and the economic data have softened. But given the fiscal tightness, given the debt to GDP ratio in the United States, it could well be that overall interest rates will be under upward pressure. And to the extent that the 5-year yield moves back above 3%, again, that's another factor that would contribute to higher fixed mortgage rates. We are also seeing, this is the forecast, the market implied forecast for the 5-year yield. At today's level, and then 1 year out, it's forecast to rise by 25 basis points. 2 years out, another 25. 3 years out, brings it to 3%. And then in the 5th year, up to 3.25. Now, obviously, this is based on the implied Bank of Canada rate expectations based on forward rates. So this is subject to change. But given that the markets are predicting that 5-year yields will be rising, and therefore 5-year fixed rates will be rising, it makes the variable rate mortgage less attractive. Now, this is the prime rate. The prime rate is based on overnight rates by the Bank of Canada. So we didn't cut overnight rates today, so the prime rate doesn't change, which means floating mortgage rates, both variable and adjustable mortgage rates, are steady, tied to prime. Prime is unchanged for the foreseeable future. It's my best bet that the next move by the Bank of Canada could be to raise rates, but not until next year, barring some unexpected shock that leads to Canadian recession in 2026, which again, I'm not forecasting. Now, this looks at the forecast curve for the prime rate and the 4-year swap rate. And you see that again, in 1 year, it's expected that the prime rate will move up to 470, then 495, etc. So again, this is the prime rate, the 4-year swap rate, and then this chart is the implied forecast curve, which we just saw for the 5-year yield and variable rate yield. So throughout the forecast period, fixed rates remain above the variable rate loans. Now, this is a forecast of what the different Bay Street economists have suggested the overnight rate will be as we move into the end of 2027. And you see TD unchanged, CIBC, well, they've got it unchanged as of the 4th quarter of 26. RBC thinks rates will be 3.25%, 100 basis points higher at the end of next year. Scotia is at 3. BMO's, again, very conservative here, 2.25% for the end of this year. And National Bank says 2.75. So the range is a maximum of 100 basis points higher in yield as we move into 2027. I think the upward movement in Canadian interest rates will be more muted. But again, uncertainty means be prepared for the worst, but in fact, hope for the best. Now, the housing market is really taking it on the chin as a result of all this uncertainty that we see. And I believe that because Canada is far more interest sensitive than the US, that's one reason why the Canadian economy is so much weaker than the US right now. Now, we haven't seen 4th quarter GDP yet for Canada, but in the United States, the number is 4.4%. We're forecasting 0.5%. So you see that the US is far outperforming Canada. Now, this is a chart that looks at, as of the third quarter of this past year, over a year's period. This looks at first-time home buyer growth, and it is occurring nationwide. So you see first-time home buyers going into the market. As well, this shows you home prices stabilizing, and the average loan size is $438,000. So this is good news for first-time buyers. There's tremendous pent-up demand, and there's plenty of supply out there, which bodes well for the spring selling season coming up this year. Now, monthly home sales have fallen. They fell in December. On a quarterly basis, they're down slightly from the third quarter and the fourth quarter. New listings have edged down slightly as well, but the sales to new listings ratio continues to edge upward. And this shows you the months of inventory as well. So we're in kind of a neutral market nationally, but clearly when you look at it from location to location, the real buyers markets are Toronto and Vancouver. The rest of the country, not so much. Calgary had very strong home sales that have subsequently slowed. Quebec in general has been quite positive, and Halifax and the Eastern Canada also are doing better than Toronto and Vancouver. The home price index continues to edge downward. It's nowhere near, as you see, the peak in prices that we saw in the beginning of 2022 before the Bank of Canada started tightening monetary policy. This shows you average prices by each province. And so what I've done here to show it to you is, let's see here, the residential average price has fallen sharply in BC, sharply in Ontario, and to a lesser degree in Prince Edward Island. And you can see here market activity. Resale declines as new listings cool. So we saw the housing activity, home resales plunge. Vancouver, Fraser Valley, Calgary, Edmonton, Toronto, positive in Ottawa, and down this time in Montreal. So I've talked to you about this before. The GTA condo glut remains with us. It's not as big as it was, but it's certainly still a problem. After so much building in 2024 and the early part of 2025, there was a flood of new condo product on the marketplace. Pre-construction sales have plummeted, rents and condo prices have fallen. Investors and buyers have pulled back. The inventory of unsold condos is at a record high, and new construction has stalled. So we need to work our way through this inventory of unsold condos, especially in Toronto, but also in the GBA. Toronto's housing starts, I'm comparing Toronto to the rest of Ontario. You see again just how weak they are. So for home buyers out there, we missed a strong spring selling season in 2025. I believe that we'll see more strength in 2026. Mortgage originations are moving up. You know, the refinancings and the renewals will be 60% of all loans outstanding by the end of this year, if you count both 25 and 2026. So a very robust mortgage originations because of the refinancings. Floating rate loan share has moved up slightly But again, with all the uncertainty out there, that's a risky play given expectations for higher long-term interest rates. But the good news for first-time buyers and all buyers outstanding is that housing affordability has improved, both because prices have come down, but also because interest rates are lower, mortgages are less costly. Homeowners do have borrowing room. This shows you gross debt service ratios. And we see that in terms, we've got these numbers coming down. So the first-time home buyer family, a move-up market, etc., there is some room for borrowing. And we may well hear from OSFI tomorrow, but sometime this week, about eliminating the stress test. If you remember, a year ago, OSFI put in place a requirement that all the major Canadian banks need to keep track of their loan to income ratio. And that would look in their mortgage books at what is the size of the loan relative to the income of the household in question. And what we see from a year's worth of data is that only about 12% of new mortgages have a loan to income ratio above 450%, which is what the Bank of Canada considers to be a hold level that's consistent with prudence. So given there is such a low ratio of risky loans, it might be that OSFI decides they don't really need the stress test. And let me tell you, by the way, that the stress test was patterned after the same test in the UK housing market. And the UK introduced a loan to income ratio as well, and they eliminated their stress test and shifted to the loan to income ratio instead. And so given that Canada is playing copycat with the UK, it may well be that they do eliminate the stress test. Let's hope. Mortgage arrears have been rising. You'd expect that as the economy slowed, and especially given all the uncertainty, but those rates are still quite low. Refinancings and renewals mean higher monthly payments. Yes, households were stress tested for higher rates, so households can afford, in the aggregate, they can afford these higher rates, but clearly it means that people will have less money to spend on other things. So 60%, as I say, of all mortgages outstanding will have been renewed by the end of this year. And 40% of that 60% are at record highs. And then finally, the big thing here, and I'm not sure that it's appreciated totally, is just how much our population has contracted. You can see this huge population growth, really incredible, given that we are not a third world country. But we've moved from very strong population growth now to an actual contraction in the third quarter. We're expecting that the contraction in population growth, you can see what a big decline that was for 2025. There'll be another big decline in 2026. And we won't start seeing an improvement until 2027. This shows you the level of the working age population, the year-over-year increase in Canada's working age population. It's de minimis now, and it had been extremely high. So we will have seen declining population for 3 years as we begin to grow again in 2028. And finally, slower population growth, it reduces economic activity. It means lower inflation, and other things equal, it means lower interest rates. So the excessive population growth that we saw earlier this cycle meant that there was excess demand for housing and house prices were rising rapidly. Now, with population reduction, house prices are stable to down, and hopefully we'll begin to see an improvement in housing activity this year, and most certainly as we move into 2027 and 2028. Well, thank you, Eddy. That completes my slide presentation, but I'm happy to open this up for questions, comments, because there is a lot to talk about.
Minutes of straight talking. You do such a great job.
Thank you.
I mean, it's just so smooth and you just do it like a pro. So thank you for that. Yeah, lots to unpack. I took 2 pages of notes, so I'll have lots to ask, but I do want to get to our questions in a minute. You talked about those renewals that are coming up. That was a big part of 2025 as well. If your mortgage is coming for renewal this year, you have to talk to a mortgage professional. There's lots to talk about, and hopefully you'll have some direction on what you should do on that renewal. Refinances, for example, and we talk about emergency funds. You talk about employment, uncertainty. Emergency funds are important. So maybe there's something we can do while everything is on the up and up and everything's good with you and your family. You may want to look at a refinance. So contact someone at DLC. You can do that at www.dominionlending.ca. We can walk you through your scenario and make sure you're taken care of on that renewal. And if there is a opportunity for refinance, what that looks like for you. I like that, there's opportunity for first-time home buyers. I have young men as children in their 20s. Hopefully they'll look for opportunities to get into the market. Affordability seems like it's coming back, which is great news. Interest rates are a subject I want to get deeper on. You talked about debt, and you talk about how Canada, compared to other G7 countries, has a lot more manageable debt. Maybe that's why our interest rates are so much better. So we'll get and unpack that a little bit more, just so everybody understands how that works when it comes to interest rates, especially around the fixed and long-term interest rates. And what's interesting is all the banks who are very smart on, economics and finance all have different forecasts on where the rates are going to go. Love to pick each economist's brain on why, some are going 1% higher than today and others are flat right across. Very interesting. I mean, obviously there's data points along the way that affect those, one of them being inflation, uncertainty, consumer confidence. All of these things play parts, but I always love to compare and wonder why one flat all the way across and the other one 1% higher. Before I get to my questions, I got a few here I want to get to. One of your favorite, biggest fans, Jason Nugent, is asking about the Japan and Great Britain buying U.S. bonds. Why? Like, what makes that attractive to them? And especially Japan. Yeah, especially Japan. Yeah. Why wouldn't Japan go? Yeah, why wouldn't Japan go, okay, let me buy my own bonds. Let me try to see if I can figure that out. It's almost saying I trust the U.S. more than I do my own country.
90% of financial assets worldwide are denominated in U.S. dollars.
Okay.
That's a fact.
Yeah.
And as a result, the U.S. Treasury bond market is the deepest, most liquid market in the world.
Okay.
Trades constantly. You're never stuck with a bond, right? It has a price at which you can sell it or buy it at any point in time. Every country in the world holds some balance of US dollars because the US dollar is the global reserve currency. In other words, when you trade with foreign countries, most countries outside of the US even that trade with one another, all many of them do so in US dollars because they don't want the Indian currency. Canada wouldn't want India's currency, and India wouldn't want Canada's currency, but they both trade in US dollars.
Okay.
So when the US dollar falls, vis-a-vis all the other currencies in the world, everybody else becomes less competitive and the US becomes more competitive. This is exactly what China has been doing for decades, is undervaluing their currency because it makes their products cheaper. So the US now is doing this because it would make American products cheaper and therefore improve the US trade balance. But that's terrible for the rest of the world. And it's a destabilizing force, and it's about the last thing we need. And would you trust your bank account, your family's net worth to Donald Trump? Because that's exactly what people are being asked to do when they hold US dollars at this point in time.
Is that why gold and silver are so popular? I mean, if you think about, if you don't want a US dollar, because you just like you sort of described, I don't know if I trust Trump, then you're going to pour into an asset that has value worldwide, and that's gold and silver. So that's a big reason why you see that rise.
Yes. And in fact, Canada's been a major holder of gold for other countries. So we've seen our gold holdings be a very important part of Canadian capital flows.
So
Canada, there are countries that park their holdings of gold in the central bank coffers of the Fed and the Bank of Canada. It's still their account. It's not that they don't own that gold, but people are moving to gold because of so much uncertainty, and that is highly unproductive. You can't take gold to the grocery store. It's not liquid.
So, okay, so I just want to Canada has no gold reserves, right? Like, we don't own gold, do we?
Yes, we do own some gold.
We do. Okay.
Yes.
I thought I read somewhere that gold, we don't have a reserve. But
no, it's that our currencies are no longer tied to gold.
Okay, got it. Okay. Right. Yeah, that's fair. Let's go to the next question, because I'm actually wondering about this. This is from Alessandro Luca, and he's talking about all the renewals with the rates being on a higher. So there's less disposable income. I mean, that's just what it is. You're going towards your mortgage. You're not buying goods and services. So how is that going to affect, the economy, like with less buying power, because you're using it for your mortgages, and we know 60% of mortgages are going to be higher and more payments can go towards it. How is that going to affect the pace of growth? Good question, Alejandro. Thank you.
It weakens it because you have less discretionary income to spend on the other things of consumption. However, keep in mind that over the period, whether you had a 3-year loan or a 5-year loan, over that period of time, your disposable income increased.
Okay.
Typically, I mean, on average, the average household saw their disposable income increase at the same time that home prices have actually softened. So it's not quite as bad as it might sound, but for sure, it means that compared to a week ago, the week after you refinance or renew, it's that much more expensive.
Yeah, exactly. Let's go to the next question. I kind of touched on this, but I want to bring it back. Mortgages by Mark. He's asking about that same thing I was talking about. So half of the lenders are saying, yeah, it's going to go up 1%. The other half are saying nothing's going to move. And, a variable rate could still be in play. I mean, a variable rate mortgage, don't forget, is not necessarily at the prime. It can be discounted from prime. Right. And many lenders do that. They discount it from prime. So you have a little bit more room. So I like what Mortgages by Mark is saying is, hey, if half are saying it's going up here, the other half are saying it's not going anywhere, that might not be a bad option, knowing that the bond markets are a little volatile. Debt from countries are going up. So maybe long-term rates, as those charts were shown by Mortgage Logic, maybe they are going to go up. Maybe variable is going to be a good play. I'm not asking if it is or isn't. I just wanted to bring that up. Thank you, Mortgage by Mark. But somebody is saying that variable rate mortgages are probably going to be the same, so it may not be a bad option.
Right. I mean, it just depends on how cautious you want to be.
Exactly. And that's just it, right? A mortgage professional, someone at DLC will go through your entire risk tolerance, your entire, sort of picture of what you want to do, and then see if variable fits for you. The next question, thanks, Natasha. The next question from Ali is, should I buy a house this year or next year? Also, do I think a fix is better option for now? So we kind of touched on that, Ali, but what do you think? Should you buy a house, Sherry?
Absolutely. This year, right now, tomorrow. No, yeah. I mean, I wouldn't wait. You don't buy a house just for financial reasons. I mean, if you need a place to live, if you want more space or less space, then you should do it based on what's available out there, what you like. And also, do you really want to wait a whole year and then end up finding out that mortgage rates have gone up and home prices are edging higher and things have turned around and you've got a multiple bidding situation again?
Yeah, no, exactly. I mean, listen, if you're ready to buy, you buy, right? You don't want to stretch yourself necessarily. You want to make sure you're within an affordable means and it fits within your budget. Yeah, absolutely, Ali. If you're ready to buy, contact one of our mortgage professionals. We'll do a pre-approval for you. Hold that rate for up to 120 days and go shopping. Why not? Sherry, I do want to talk about OSFI because I got a lot of questions this morning around that change or possible change. I mean, obviously, if they make an announcement this week or next, it's not that announcement's not going to happen this week or next. It's going to say, hey, by this time, there's a lot of moving parts in that change for the banks and financial institutions and all of these, mortgages that need, time to change the stress tests on their models, et cetera. How long will it take if they make that decision before it actually comes into play? March, April, mid-year? What do you think?
Yeah, I don't know. That would be something that you'd have more to say about than I do. But I think they may do it just because it's just one less thing to pour sands in the gears of what is already a underperforming housing market.
Right. And the LTI, loan to income, at 450, do you think that's the right number? Did they take that number because of the UK? Any thought around that?
Well, it doesn't sound so high given how high prices are in places like Vancouver and Toronto and given what median income is. But there's no question, though, that Canadians are very prudent mortgage borrowers. Yes. And they'll pay their mortgage before they would pay their credit card bills or anything else for that matter. And I don't think that there was a real risk, even before the stress test, of people becoming overextended the way they did in the US during the financial crisis.
Right. And by the way,
we don't have that kind of subprime market.
Right. And by the way, your slides show 12% of people that wouldn't qualify under the LTI or the mortgage existing wouldn't qualify. Keep in mind, this is an average. So not every deal has to be at 450%. So you're going to get exceptions. So don't panic, sit there and calculate and go, oh my God, I can't afford or I will not get a mortgage. It's not that at all. They're mitigating that risk right across portfolios of banks. So there is going to be opportunities to go beyond that 450%. So I just wanted to make that clear. Talked to a lot of very smart people at financial institutions that also shared that with me. So Shannon Woolley, you just asked about the anticipated when it's going to happen. It's supposed to be announced this week or next week, I think, Sherry. And then by the time it actually gets implemented in the financial institutions, it may be months. Let's go to Michelle Mortgages. Can Dr. Sherry Cooper clarify? The Bank Canada unloaded the last gold coins in the reserve in 2016, but the bank began the process in the 1970s, arguing that it made no sense to hold such a liquid asset. You mentioned, we don't really use gold anymore to back our financials. So you're going to explain that in a minute. So her question is, what is her question? Countries no longer fix their currencies to the price of gold October 21st, 2025. So that's right. Michelle, yes, I think nobody really uses gold to back their currencies anymore.
No, they don't. But for sure, people buy gold stocks, or they buy gold mining companies, or they buy gold, bullion,
Sure.
in order to diversify their portfolios, to have a safety cushion. But the problem with it is it's not like cash. It's not liquid.
Yeah, and there's a lot more gold and silver used in products for AI data centers. I mean, there's got to be a little bit of that. I don't know how much of it.
Yeah.
I'm sure they're looking at a demand of those precious metals in goods, especially around data centers, AI, et cetera, et cetera. Okay, let's go to Alexander Luca in Quebec. Desjardins, a major lender, has recently tightened access to HELOCs, limiting borrow to 65%. So there's already reaction to what's going on. In practical terms, borrowers need to be at least 35% equity before they can access the HELOC. Are there any federal regulatory signals of this policy discussion suggest other lenders may move in that same direction? Is that a Desjardins decision because they're trying to mitigate their portfolio, or do you think that'll go right across all lenders?
Right now, it's a Desjardins phenomenon. I don't think that Royal Bank will do this, for example. The Canadian bank stocks have done extremely well in the last year, and they are in solid fundamental shape. So,
do you think Desjardins getting ready for the LTI and saying, "Hey,
could be.
Maybe they're anticipating the LTI and then saying, okay, if we do this, it'll give us more bandwidth on the fixed stuff." Who knows? But that's interesting. We'll keep an eye on that. Thanks, Alessandra. What else do we want to talk about? We have we're actually over time. Do you want to just? I just wanted to ask you just again to go back to the bonds, because I really think it's interesting. You're saying that as national debts increase, then there's going to be a premium to buy that bond for that country for the risk. You see Japan, you just mentioned Japan is going way up and nobody wants their bonds because I guess the risk outweighs the return.
No, it's because, look, just remember, if you buy bonds today and interest rates rise, that means your portfolio of bonds is worth less.
Okay.
Because the prices have fallen.
Right.
And that's why people are afraid to get into the Japanese bond market, which is why the bond market is crashing, because they're afraid they'll lose money. And there's every evidence that they will, because the values, we just talked about, loss of $7.2 trillion on paper. So, it's like, if you know that if you buy a stock tomorrow that it's going to be worth less, you're not going to want to buy it unless you're going to short it.
Okay.
So it's a similar fundamental.
Similar. Okay. So in Canada, we obviously have bonds that are attractive. People like the security of those bonds. So the more they buy the bonds, the
higher the price, the lower interest rates.
Right. So, but now you saw the bond market, you said it's going to probably go up over 3%. So they're selling those bonds.
Right.
They're selling those bonds because they can get better returns or safer securities elsewhere.
They think, or possibly. I mean, nothing's guaranteed, right?
If the US dollar keeps getting weaker, that means our dollar gets stronger. Would our bond market be more attractive to foreign investors?
No, because our interest rates will go down relative to the US, but they may be more attractive because we're safer.
We're safer. Okay. Yeah. So I just want to make it clear that, bond markets are affected by people buying or selling them. And right now, as yields go up, it's because they're selling them.
Right.
Or they're not as interested in them. And if quantitative easing, which is the government going into buying the bonds to help the pressure, alleviate that pressure, and the rates come down, helps the economy.
Right.
Right now, Sherry, are we in quantitative easing or tightening or neither?
We're pretty neutral. We're
pretty
just
neutral.
neutral.
We're not buying or selling. We're just hanging out and just, okay.
Yeah.
Okay. Cool. Well, that's all. I just wanted to make sure that bond piece was clear. It probably isn't much clearer. I don't know. maybe.
Well, listen, honestly, it's very complicated.
It is,
None of us know.
Yeah.
And so, I mean, that's why people are afraid to buy homes. They don't want to make important decisions because there's so much they don't know about what the future will hold. And uncertainty is a very negative thing for decision making, right?
Well, I don't mind sharing my mortgage coming up due in March. I'm going to go variable rate with a discount because I believe that there's just a lot of pressures out there. And, you know, if the movement happens, it's not going to happen to me. I don't think it's going to go as up 1%, maybe not stay flat, but I'm okay with a 0.5%. So that's where I'm going. I mean, I've been comfortable going variable rate. So it's something I've been doing. And if you look at the long term, variable rates have done well compared to the fixed rate. So that's where I'm going. But
well, that's because, Eddie, in the long term, in our life, long term,
yeah,
from 1950 to the present, let's say, rates went up from 1950 until 82 or 3 or 4, and then they started to go down. And that's when Japan had negative interest rates, you know, just a few years ago, the beginning of COVID.
Right.
Our overnight rate was 1 3/4%, like 175 instead of 2 1/4. And look what's happened. You know, it's no one knows what the future will bring, and so you're trying to, you know, assess what would it mean to you if you're wrong.
Yeah.
And as long as you can tolerate rates
Exactly.
going up,
yeah,
fine.
It's conversations. It's just, you know, doing the best you can, educational guess. Like, you don't want to just guess. You want to go through a scenario of where you are today, where you want to be in, say, 3 to 5 years, and then do the best for that moment, right? It could be variable, it could be fixed, could be short term, could be long term, but at least have an idea of where you're going. And our mortgage brokers can help you do that. Okay, we are now 7 minutes over. I don't think we've ever been 7 minutes over.
I know. I'm going to cut back my presentation next
This
time.
might be a trend for 2026 where there's so much going on, which is okay
right.
by me. Everyone that joined us today, thanks so much. Thanks for staying over time. Until next time, March 18th will be our next. So we got a break in February. We'll freeze a little bit longer, and then hopefully by March 18th, we'll start thawing. Thanks, everyone. Take care. Bye-bye.
Bye-bye.